Should not bail out lenders, real estate speculators, or those who made the reckless decision to buy a home they knew they could never afford.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to discuss the massive foreclosure cover-up that's going on around America. And I'm going to prove to you guys beyond a shadow of doubt that the main provider of data is covering up the true picture of the distress of the current homeowners around America. I'm going to show you guys all of the reasons why we cannot trust these data providers. Their job is to get us and the professionals to remain optimistic so we continue to spend to the end. And I think, guys, what we really need to do is we need to rewind the space-time continuum and remember where we came from.
This is an extraordinary period for America's economy. Over the past few weeks, many Americans have felt anxiety about their finances and their future. I understand their worry and their frustration. We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed. As uncertainty has grown, many banks have restricted lending. Credit markets have frozen, and families and businesses have found it harder to borrow money. We are in the midst of a serious financial crisis.
I want you guys to remember this was after a full-fledged recession. I'm sick and tired of all of these people, all of these bulls that think that they're so smart. They think that they can fool us. They want us not to trust our eyes, not to trust the simple math. They just want us to trust them. But they're covering up the data, and so we will never, in my eyes, be able to trust these data providers again, because they have allowed their financial bias to supersede the honesty and integrity of their company. I hate when people compare foreclosure data to what's going on right now compared to the midst of the recession. You cannot do that. If you do that, it's delusional. It's not a fair comparison. You're comparing a watermelon to a grape. You can't do that. If you're going to compare, you got to go before the recession, 2006, even 2007. But make no mistake, the pain was felt deeply, even in my own household. And remember, this is a big thing I'm always saying. You guys got to stay prepared. One of the things that will happen when we face another financial crisis, which is around the corner, credit tightening. People don't realize how hard it becomes to get credit. And that's why cash is king. But not only that, businesses continue to close down. More and more Americans file bankruptcy, and the American purchasing power is shot. We have to remember these things because so many people, including myself, right before the GFC were blindsided. And because we were blindsided, and how could we not be when the data cover-up existed back in the GFC as well? You guys, we were blindsided, but that doesn't mean we need to let that happen this time around. And if we do, the only thing that's going to happen is we're going to allow Wall Street to once again get filthy rich off of the backs of our pain and financial struggles. And you probably have seen it in the comment section. You probably have seen it around YouTube. The elites want America to be a nation of renters. Now ask yourself this question. Wouldn't that plan be accelerated if housing did crash? So if you believe that the elites really want that, and how could they not? I mean, we see it in the numbers. Make no mistake, a value crash blindsiding America would push that plan along. And don't forget, you guys, we already have their blueprint.
Steve Mnuchin, the President's Treasury Secretary, Wilbur Ross, the Commerce Secretary, Tom Barrack, the President's close friend who planned his inauguration, Steve Schwartzman, the Chairman of Blackstone, Jamie Dimon, the head of JP Morgan Chase, the biggest bank in America. These are the people that I describe as homewreckers.
Why are they homewreckers? Why are they not just investors in the real estate market?
They are homewreckers because they are the people who swooped in after the housing bust when 8 million Americans lost their homes and profited tremendously, taking the wealth of those families and putting it in their pocket.
The GFC was more about a loan modification and a short sale crisis than an actual foreclosure crisis. A lot of people are like, nothing's going to happen because there is no foreclosures, even though they're comparing that to, again, the midst of the recession. But again, don't make the mistake of that mainstream narrative. There was a foreclosure inventory explosion, because the reality was there wasn't. What happened was, during the GFC, the short sales were an issue and loan modifications were an issue. But the loan modifications, all that did was keep people stuck in their houses. So even though a notice of default or a foreclosure was filed, some of these people got to live in their house for 10 years. We didn't have the loan modification process we have right now. So it's fair to say, back during the GFC, people had a higher likelihood to stay in their houses. And the reason is again, there was just such a mess with loan modification. Anytime an error or violation was made by a servicer or a lender through loan modification, they had to start the clock and waiting period all over again. And that happened all the time because loan modification, you guys, was new.
We share your concern about rising foreclosures and the need to limit them wherever possible. Everyone suffers when a foreclosure occurs: borrowers, lenders, investors, and the neighborhood where the property is located. Thus, it is no surprise that banks are actively engaged in voluntary modification programs on an individual basis and as part of an industry-wide effort such as the Hope Now initiative.
Along comes Hope to bring hope to these troubled homeowners. And again, you guys, that really just helped the banks. And I think that we're starting to figure out, anytime legislation or spending is passed, is to protect the bank at our expense. Now, they'll say that they have to protect the bank so that we can continue to flourish and borrow money. But I say, let's just stop borrowing money and only spend what we have. Let me know if you agree with that statement. Another piece of legislation, huge piece of legislation, was passed called the Dodd-Frank Wall Street Reform and Consumer Protection Act. Through that piece of legislation, qualified mortgages were birthed. They made additional guidelines for lending that was supposed to stop lenders giving loans to people that could not afford their payment. Now, what I'm trying to tell you guys is, right now, when we look at the debt to income ratio, the affordability ratio, it is higher. It is more unaffordable right now than the subprime collapse in the past. Now, if you're wondering, how is that possible? These laws were supposed to eliminate that. Now, here's the problem, you guys. Another thing that was created and really pushed was called AUS, Automated Underwriting System. And the regulation initially said the maximum debt to income ratios were 26/36%. That changed to 43%. And then after that, they did away with maximum debt to income ratio and did things based on pricing and risk. Now, let me explain to you guys what the issue is with that. And let me also explain to you guys that instead of them protecting us as consumers by adhering to those guidelines, this is what happened instead. This is a CFPB, or the Consumer Financial Protection Bureau, report dated 12/29/2020. And let me read this to you guys. Okay, this is pertaining to qualified mortgages. And the issue is they were finding out, and this is from Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac purchased the loans from the lenders. So Fannie Mae and Freddie Mac are purchasing all of these loans. They audit the loans in 2018, and they find 16%, or nearly 1 million homes, are in violation of qualified mortgage protection, meaning that they violated policy and still gave us homes that we could not afford. That's probably why the debt to income ratio is higher now. DTI must not exceed 43%. And again, remember, it was originally 36. This final rule amends the general QM loan definition in Regulation Z. Among other things, the final rule removes, this is the problem, the general QM loan definition's 43% DTI limit. That's a good thing. That limit protects us as consumers and helps reassure the taxpayer, because we're sick of bailing people out, that these people purchasing these homes can afford it. This goes on to report the affected loans would include loans for which the consumer's DTI was above 43%. You guys, they're saying that mortgages originated in 2018. They did that audit and they found 957,000 loans, or 16% of all foreclosed loans, first mortgage loans, were in violation of affordability. And what did they do, you guys? First, let me explain what they should have done. All that they needed to do was stop allowing lenders to go into the back end of AUS to adjust the debt to income ratio thresholds. They allow lenders to violate law and policy. And instead of them tightening that up, just take that ability away from the lenders. Just keep the maximum 43% instead of them protecting us as the consumers. All they did, y'all, is they just simply changed the policy. They simply changed the policy instead of saying, time out, all of these loans are in violation, this is a huge problem. Instead of that, once again, they protected the lenders over protecting the consumers, and that will lead to massive foreclosure challenges. Now look at this, guys. While we're all in lockdown trying to figure out what's going on, they changed this rule and made it effective March 1st of 2021. Raise your hand if you knew that. And what I'm saying, there is no original QM protections. And I was a big advocate for explaining to people the difference in subprime income verification to right now. But when we look at the affordability and we look at the debt to income ratios, what we have right now, you guys, with the newly originated loans is we have an unaffordability problem worse than the great financial crisis. Now, here's the thing here. Again, this is why everyone's going to get blindsided. They're covering up the data. And so now, you guys, let me prove this to you let's take a look at June's Black Knight foreclosure report. So I'm going to compare what Black Knight has compared to what HUD does via survey. Now, the reason I have such an issue with this is because Black Knight is a leading data provider for the industry. And I'm about to show you they're not even covering half of the delinquencies and defaults. They're not even covering half. They're missing a massive piece of the pie. They're covering up all of the bad things and only talking about the good things. And even with that, look at the first bullet point. The national delinquency rate jumped 14.5% to 3.49%. It's the second highest level in 18 months. So even though they're looking at the data through, and again, this is my opinion and interpretation of this data, through rose-colored lenses, it's still showing us the trajectory of delinquency is skyrocketing. A month-over-month increase, even though it was low, a month-over-month increase of 14.5% means that there is something wrong in the background. And then when we understand that this is all rosy-colored, how bad did it really get? Unfortunately, we can't see that until HUD comes out with their July survey data. Now let's go over Black Knight's chart real quick, and then I'm going to be done with this because I don't want to waste my time and I don't want to waste your time by looking at data that's not giving us the accurate depiction of what's going on around the nation. Now, again, case in point here, remember the delinquency rate. They're saying it's 3.49%. Again, that's up 14.5%. Here's the case in point. They're saying the number of properties that are 30 days or more past due or are in foreclosure is 2 million properties. However, unfortunately for them, HUD also does an analysis on people that are struggling to pay their mortgage. And when we look here, homeowner households that are behind on their mortgage totals 5.3%. The true delinquency rate is not 3.48. The true delinquency rate is a minimum of 5.3%. That is a massive discrepancy. And not only that, when we take this 5.3% delinquency rate and we multiply that by the sampling rate, which is 82.5 million US households, we get total delinquencies of 4.3 million, which means Black Knight is not showing us 2.3 million pieces of data. And so my question is this: if we know Black Knight is looking at less than half of the true picture, and if we know that Black Knight is collecting data from the top servicers, meaning the servicers don't have as much delinquency as other servicers, then how can we trust them? And if they pride themselves on data integrity, my question is why does HUD say the delinquency rate is in the 5s, but you say it's in the 3s? And why are you only using roughly 47% of the data? What does the other 53% of the data look like? Well, I don't think we have to ask. We know what it looked like. The delinquency rate of the other 53% is well over 3.5% delinquency. And so, you guys, I'm done with Black Knight because in my eyes, they are completely useless. As much as this hurts me to show you, I want to show you some of the things that happened that created a double bubble. This is mortgage-backed securities purchased by the Fed. And I'm constantly telling people, you guys be careful. We are so overvalued right now. It's going to make our head spin and make the Great Depression look like child's play. One of those reasons is because we're not in a bubble. We're in a freaking double bubble. And this is one primary reason why, you guys, during the end of 2012, all the way up into the mid to end of 2014, the Federal Reserve went on a mortgage-backed security buying spree. What that does is it loosens up credit and it allows artificially low interest rates to stimulate the housing market. This right here that you're saying should be against the law because this is manipulating the banking sector and it is manipulating the dollar, and this is our money being spent. This right here, you guys, is one thing that I wish they would make against the law, again, which is mortgage-backed securities. But not only that, you guys, don't forget, most appraisers are not appraising property correctly. This is not emotion. This is not a guessing game. We have a pamphlet right here where it states the price represents the normal consideration for property sold unaffected by special or creative financing or sales concessions. We know when it comes to new home building that they offer crazy sales concessions. And so when they did this review and report, they found 58%, okay, of the 7.6 million comparables were not done correctly, and the appraiser made no adjustments for concessions. That's value fraud because they were warned right here. And I've received multiple appraisals from viewers just like you that are showing comparables from 1, 2, 3 months ago where the same thing's happening. No adjustments are made for concession. And so we have these lies and fraud built on these lies and fraud, and it's just getting bigger and bigger and bigger. But guess what, you guys? It's starting to fall apart because the fraud and quantitative tightening is so powerful now that things are starting to break. Another thing with the fraud, you guys may have seen my Mitch Wexler video. If you haven't seen that right now, we've uncovered a massive accumulative corruption value fraud on the Central Appraisal District level. The Central Appraisal District are acting like appraisers and appraising property. The only thing is they're not following the rules. They're required by law to follow rules on appraising property. And I could tell you, as someone that has protested the value of my property, it's slop. What they're doing is nothing short of fraud. And as homeowners, we have to do something about it. And if you're on the sideline, take all of the things that I'm saying to you right now as reassurance. And you guys, here's the thing. What I'm saying with the Central Appraisal District and what Mitch Wexler has taught me, it's nothing new.
All people have come along in some instances and inflated and actually had assessments made that were way out of line relative to the actual value.
December 18th, 2007. And so let me ask you, what's the bigger issue here? Is it the greed, corruption, fraud, or is it that as consumers, we forget? And we forget, you guys, big time. And so let me end this video showing you just one more graph. This is our foreclosure inventory graph. And so anytime a bull says, oh, what foreclosure problem? What foreclosure problem? You guys, please do me a favor and remind them that we didn't have a foreclosure problem until we already entered the GFC, which is right here. Okay? So people want to compare right here to us entering the GFC. That is absolutely psycho. If you really want to look at what was going on, you have to look prior to the GFC. And you will note that as far as foreclosure inventory, that's when people lose their houses. You will note that we are not, it is lower right now, but we are not far off. So we know that we're not far off. We know that this data, this is Black Knight data, okay? They only have 47% of the data. And so when we use all of the data, you guys, We're more like up here. In other words, if we keep our heads in the sand, if we act like these homes are not really overvalued, if we act like we're not going into recession, if we choose to ignore our history, we will be blindsided. But that doesn't have to happen to you. And do me a favor, you guys, comment below. Let me know that this information helps you. Let me know that you're finding value in my videos. Share it, like it. And other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win.